Welcome to a deep dive. Today we're really plunging into a stack of sources all about AMC Entertainment, the movie theater chain that always seems to be in the news.
That's right. And we've pulled this material together specifically to, well, unpack the key insights, maybe some surprising details, and really the important nuggets that these sources contain.
Yeah, our mission here is pretty straightforward.
Yeah.
Help you understand the core story these sources are telling. We're looking at AMC's recent market moves, its ongoing financial challenges.
What could potentially spark a turnaround, and also how it stacks up against, well, at least one key competitor. And just to be clear, everything we discuss, it's based only on what's in this material we have here.
Okay, let's dive right in then. The sources, they seem to start by setting the scene, and there's this really striking contrast right off the bat.
Immediately, yeah. The material acknowledges, some recent positive momentum for AMC stock. It's apparently up about 28% in just the last 2 months.
Which, on the surface, sounds great.
It does, but the deeper look in these sources immediately puts that against the long-term picture. They point out that even with that recent bounce, AMC is trading more than 99% below its split-adjusted high.
99%?
Yeah, the high reached 4 summers ago. That 99% drop, that's a huge figure. It really underscores the long-term challenge here.
Wow. Okay. And looking at the core financials, the sources seem to paint a picture of, strain. Revenue declined last year.
It did, and it's actually been down in 4 of the last 5 quarters, according to this material.
4 out of 5.
Mm-hmm. And the sources note that trailing revenue, revenue over the past 12 months is still 17% below its 2019 peak before the pandemic.
Right, and profitability.
Well, that's maybe the most telling part. AMC hasn't reported an annual profit since 2018. So you've got this recent stock uptick, yeah, but it's happening against this backdrop of, significant multi-year financial headwinds.
Okay, so that definitely paints the challenging picture they start with. But looking forward, the sources also point to some potential game changers, right? Some possible catalysts.
Yes, they do. And one of the biggest points emphasized is that traffic seems to have picked up significantly in the current quarter, which is Q2 2025.
Ah, okay. And there's a specific number on that.
There is. The sources cite that domestic ticket sales are currently 25% higher than they were at this exact point last year.
25% higher year over year for the quarter so far. That's substantial.
It is. And the sources directly link that surge to the film slate. They specifically mention that this year's 3 highest grossing releases theatrically all came out in this quarter, Q2.
Right. The material calls out a Minecraft movie, Lilo and Stitch, and Sinners.
Yeah.
Yeah, those definitely feel like they draw people back.
Absolutely. And based on that stronger traffic in Q2, analysts cited in the material are expecting something like a 26% jump in revenue for the quarter.
And the sources note that would be its strongest showing in nearly 2 years.
That's what they say, yes. Strongest in quite a while.
Okay, now here's where it gets really interesting, I think. Looking ahead to the rest of 2025, the material describes the upcoming film schedule as a murderer's row of releases.
Mm-hmm. That's the phrase they use. It sounds pretty packed.
Yeah, they list some huge titles. Avatar, Fire and Ash, Jurassic World, Rebirth, Wicked. For good, Zootopia 2. Plus, new Superman and Fantastic Four movies.
Yeah.
That lineup alone feels like a potential major boost.
That content pipeline is absolutely crucial. You see, analysts are projecting overall a 7% increase in revenue for the full year 2025.
Okay.
But the sources suggest that even that 7% might turn out to be conservative, given the strength of that second half slate.
Right, if those blockbusters really deliver. And it's not just the big movies, is it? The sources also mention some operational things AMC is doing.
Yeah. A couple of other positive points. They note that long-term debt is contracting going down for the 5th year in a row.
Okay, that's good.
And also that AMC is rolling out more premium in-theater offerings, things designed to, boost how much each guest spends beyond just the ticket price. More food, better seats, that kind of thing.
So those are definitely positive operational trends highlighted,
Mm-hmm.
but the sources are also really clear that there's a significant persistent headwind, right? A major challenge that sort of pushes back against these positives.
Yes, very clear on that. And the one they really hammer home is the share count.
Ah, the share count.
Precisely. The sources identify the primary challenge as the share count halving, and they use the word exploded since the pandemic began.
Right, even after that reverse stock split a couple of summers ago.
Exactly. The 1-for-10 split consolidated shares, sure, but according to this material, it didn't erase the fundamental issue, which is just the vastly increased number of shares outstanding now compared to before the pandemic.
And the consequence of that.
Yeah.
How do the sources explain why that's such a big deal?
Well, they're quite explicit. This bloated share count is presented as a significant reason why AMC has been one of the market's worst performers over the last 4 years.
Okay.
The sources highlight that it fundamentally impacts per-share profitability. Basically, even if the company manages to make a decent total profit, that profit gets spread across so many shares.
That the earnings for each individual share stay really low. Or even negative.
Exactly. It makes it much harder for the stock price to go up based on traditional earnings metrics.
Yeah.
It's described as, an uphill battle against that dilution.
Okay, that explanation really clarifies why it's such a persistent problem mentioned in the sources. Now, they also bring in a comparison, right, to a competitor, Cinemark.
Yes, they look at Cinemark, which is a smaller rival, and they draw what the material calls a shocking contrast.
Shocking contrast. How so?
Well, for starters, Cinemark has actually been profitable since 2023. Remember, AMC hasn't seen an annual profit since 2018.
Right, profitable since 2023. And the sources also say Cinemark resumed paying a quarterly dividend this year.
They did. Which, does suggest a pretty stark difference in their current financial health as presented in this material.
It really does. And connecting that back to stock performance.
Well, the sources point out that Cinemark's stock has actually moved higher over the same 4-year stretch that AMC has lost, 99% of its value.
Wow. Just putting those two trajectories side by side from the sources.
Yeah.
Yeah, that's quite revealing.
It is. But then, despite those drastically different results in stock performances, the sources mention something they call an even more shocking similarity.
Okay, I'm intrigued. What's the similarity?
This is where it gets really thought-provoking. The sources point out that AMC and Cinemark are currently trading at the exact same enterprise value to trailing revenue multiple.
The same multiple. What was the number?
2.1.
Okay, let's pause on that. Enterprise value to trailing revenue.
All right.
Just remind us what that tells us and why it's surprising they're the same here.
Right, good question. So this multiple, it basically compares the total value of the company that includes its stock market value and its debt. The whole enterprise compares that to its sales over the past year.
Okay.
It's often used as a way to compare companies based on sort of their size and how the market values their core business operations, kind of regardless of their debt levels or their profitability right at this moment.
Got it. So it's like saying for every dollar of sales they made last year, the market values the entire business debt and all at $2.10 for both companies.
Exactly right. And the sources highlight this as surprising because, well, Cinemark is profitable, it's growing, it's paying a dividend, while AMC isn't profitable and has faced all these significant challenges we've discussed.
Yeah.
So the sources suggest this similarity in that specific valuation multiple raises an important question. Maybe about how the market is pricing future potential, or perhaps the inherent value of just being in the movie exhibition business itself. Valuing both at the same rate relative to their recent sales, even though their current financial health looks so different on paper, it implies the market isn't just looking at recent profits.
That really is fascinating. It definitely adds a layer of complexity beyond just looking at, the stock price or simple profit numbers. So, okay, bringing it all together, what's the final outlook painted by these sources?
Well, the material seems to reiterate that the turnaround appears to be starting this quarter, Q2 2025, driven mostly by that strong film slate we talked about. That seems to be the central point of near-term optimism.
But it's definitely tempered optimism, right? You mentioned analysts.
Exactly. It's tempered because, according to the sources, analysts don't actually see per-share profitability happening for maybe a couple more years. So the road ahead is still described as pretty long on that front. The strong movie pipeline from the studios, it's described almost like a necessary lifeline for multiplex operators like AMC. It's the content that gives them the chance, the opportunity to capitalize.
And the sources kind of end with a clear message, almost like a warning, using that popcorn analogy.
Right. They say AMC can't fumble the popcorn bucket again. Essentially, they need to execute well and really take advantage of this potential moment that the film slate is providing.
Makes sense. The opportunity is there from the content, but successfully navigating those underlying financial issues.
Yeah.
Especially managing the impact of that share count, that remains the critical challenge presented in this material.
Absolutely. That's the core tension highlighted.
So there you have it, our deep dive into these sources on AMC Entertainment. We've seen this story of a recent stock bounce that, well, really needs to be viewed against a very challenging long-term financial picture.
And those upcoming potential catalysts, like that blockbuster film slate, balance against the persistent issue of the bloated share count and how that impacts per share value.
And then that really intriguing comparison to Cinemark. Different financial performance recently, but surprisingly, that similar valuation multiple relative to sales.
Yeah, this deep dive hopefully helps you understand the complex factors at play for a company like AMC that gets so much attention. It really highlights how different metrics ingears, revenue growth from movies versus the structural challenge of share count versus actual profitability versus how the market values the business compared to sales, how they all interact, and frankly tell different parts of the story.
It really does. And it leaves us with a thought for you, the listener, to maybe chew on. How much can a really strong lineup of movies truly compensate for underlying financial and structural challenges in a business like this? What stands out most to you from this deep dive?